In this video, I'm going to take you behind the scenes of one of the biggest investing scams um, in history and show you just why, why investing in crypto, while it sounds like a good idea, and for a lot of people, it might have worked out, but why it's much, much more dangerous than it appears on the surface, and why you could lose literally everything that you invest in crypto. And I'm talking about the Sam Bankman-Fried um, crypto scam, right? Sam Bankman-Fried. I mean, this is a serious topic, um, and the reason why, it's so stunning is literally because just looking at the numbers involved in terms of losses, just how much money investors lost. You're talking about billions and billions of money that it's just so stunning, man. I'm telling you, like, investors lost their shits in this. All right, so let's get into the story so you can understand exactly how Sam Bankman-Fried and other fraudsters like that in the crypto markets really pulled off one of the biggest scams, investing scams in history. That's now ended up with some of them being sentenced to like decades and decades of prison time. Right? This was a big scam. This was not a small theft. This was a massive, massive, like gigantic scam. So Sam Bankman-Fried was the founder of two businesses. All right, he was the founder of FTX, a cryptocurrency exchange. So this is where you would go to buy and sell tokens. But as far as I understand, he was focused more on the institutional. So like if you were like an investing company, or if you were some kind of pension fund, although I guess you really wouldn't be able to invest in crypto in that case. But let's say you run some kind of crowd fund that's invested in crypto, or some kind of market making company, and you want to hold some crypto to make your operations, you are involved in crypto in some way. If you were some kind of, so catering to those kinds of institutional funds, right? So, and this is where those guys would be able to go in and buy and sell, whether it's Bitcoin or it's Ethereum or some other crypto token. So that's kind of what FTX was. Um, and he was also the founder of a second business known as Alameda. Now, what Alameda was a hedge fund that was focused on crypto, which is interesting. Like, so he's doing two things, two different businesses, but where a big danger and a big red flag that opened the door to this whole fraud comes in is that Sam Bankman-Fried, um, his two businesses were kind of symbiotic in the sense that a rise in one of them could make the other a little bit more potentially powerful. But that's also where the danger was, that he would be tempted to use one of these two businesses to prop up the other. So let's say, for instance, his crypto exchange was failing. He might be tempted to, uh, to bring in his hedge fund to support his exchange. Or if his hedge fund was failing, then he might be tempted to bring in his exchange to support the hedge fund. And um, while that might seem like those are good things, if one business is failing, you should bring in another. That might be okay, like if you're running like a publishing company, and then your other business is like a restaurant, right? Like if we need to support the restaurant, we can advertise in the publishing company. If we need to support the publishing company, we can have the restaurant buy we can have the restaurant buy advertising in the publishing company, so that improves the income for the publishing company. So it's okay. Sometimes you can pull it off where two businesses that are symbiotic can actually support each other in a good way. But in this case, it wasn't. It was a risky. It was a bad setup, simply because the assets that he would be using in either case were not his. Like in a hedge fund, these are not your assets that you actually own. The assets that a hedge fund manages belong to investors in the hedge fund. So this is why this was ethically a bad setup to even begin with, because uh, it opens the doors to misappropriating and misusing customers' funds. Same thing with the exchange. The assets on the exchange don't actually belong to the exchange. They belong to the depositors that have deposited them on the exchange for safekeeping and transacting. And so the exchange is not supposed to ever use those assets, cannot use them to prop up the hedge fund. By the same token, the hedge fund's assets can never be used to prop up the exchange. But Sam Bankman-Fried would end up doing exactly that. You would end up crossing that red line due to cover up his fraud and in particular the failures of his businesses. So okay, let's look at why the exchange actually failed. The reason why the exchange eventually failed was they were actually misappropriating a lot of the assets that customers might have deposited on the exchange. Um, they they had a deal with the hedge fund where the hedge fund was acting as a participant on the exchange to provide liquidity. But one thing they did was that if the hedge fund ran a loss and it was supposed to put up additional capital, because they didn't have the money to do it, they would let the hedge fund keep trading on the exchange even if it had run a loss and needed to put up additional capital. They secretly didn't have that requirement for the hedge fund. The requirement was in place for every other party transacting on the exchange, but with their own hedge fund, they kind of did it in secret, where they allowed this uh, illegal move to actually happen, which meant that they'd kind of wait and let the hedge fund keep transacting, and then they would cover that loss like later on when the hedge fund like maybe made a good trade on a different token or some other thing. So what this did is that it opened the can of worms to where the exchange was literally losing money, because it was maybe giving that money to the hedge fund to cover some possible losses that the hedge fund had, and kind of keeping that secret. So if you put in, let's say you've put in 100 million on the exchange, and then the exchange, you're a customer, right? And then the exchange takes your 100 million and it sends 20 million to Alameda, the hedge fund, to cover some positions that Alameda has that have run a loss. And so they keep it secret from you. They say, hey, we got you 100 mil. It's okay. There's nothing to fear. We got you. But all they got left is 80 mil, and they've moved 20 million to Alameda. And Alameda is like, don't worry, guys. I'm a covered. I'm a retain the money. And Alameda, I guess at first they did retain the money, like when they covered their positions. Um, but this is where it gets interesting, because Sam Bankman-Fried, and this is where a lot of manipulation happened. Sam Bankman-Fried happened to own positions in a lot of crypto tokens, including FTT and Solana and some other ones. So what this does is that because these assets were on the balance sheet of both the hedge fund and also his crypto exchange, he started manipulating, like when he's run a loss on any of his other trading positions in the hedge fund, he started manipulating the tokens that he was holding to try to prop them up. Like he would manipulate. So this is why, if you are literally trading in the crypto markets, why it's so dangerous. And this kind of stuff, I'm pretty sure, still happens to this day. uh, Sam Bankman-Fried just happens to be one of the ones that went bust doing this. But if you're in the crypto markets, you're literally trading alongside guys like Sam Bankman-Fried that are propping up coins that are not worth however much they say they're worth. So they can make, like, if they need to make a bunch of money and try to make a lot of money quickly, maybe to cover a loss that they had elsewhere, then they could actually pump up the price by reducing the supply of whatever token. So this is where you see a lot of pump and dump schemes, where they pump up a token. Maybe it's a new token that's coming to the market. They scoop up a lot of market share, and then they put up a lot of positive information on Twitter and other social media, and everybody is hyped up about the token and starts buying, and you see something go from, like, maybe like $100 to like $500 in a couple of weeks, and everybody starts jumping in and saying the crypto good days are here again. Everybody, we need to buy this token. And then what these manipulators do is, now they know, like, oh, we got all these thousands of people in now into the deal. They've bought it, and these guys are selling the token to all these guys. And then what they do is, they come to the point where now it's time for them to get out, and a lot of people are still trying to get in. And then these insiders, they sell off all that token that they were holding, because they know, like, the stories they've been telling in the media to pump up the token, the asset, are completely fake. And so they sell out ahead of time. 2 weeks later, the promises that were promised are reviewed to nothing is happening. And then people start getting cold feet because they are holding this token that they thought was gonna go up forever. And then, a story leaks in the news that maybe some investigative reporter discovers, oh, this claim is completely bogus. Nothing, nothing of the kind is ever gonna happen. And then everybody kind of slowly realizes they've been duped. So of course they rush for the exits. Everybody starts selling off the worthless token, and the price immediately crashes. And if you were one of the ones that got in at like $200, and then the price crashes to like $3, like you can literally lose all your money, right? So these were some of the schemes that these masterminds were using to try to grab some money to prop up some of their failing trades. And that's a general look at the kinds of things that were happening. Like, Sam Bankman-Fried wasn't the only one, right? Like, he had a pretty huge network. He was well connected to other crypto investors, politicians. He was well connected to academics, all kinds of people. Like, he's a guy that had a huge network. So in the markets, in the crypto markets, whatever market, whatever token that might be, there are still people like that will be manipulating these tokens. So it's really the Wild West. If you are investing in crypto, this is something I don't see getting talked about enough. There are still a lot of manipulators. It's still the Wild West. So that's my, my take on all this thing. If you are investing in crypto, you better be aware that there are all these manipulators, and that it's probably gonna be a long time before crypto becomes like a safe investment asset class. If you look at, like, the S&P 500 stocks right now, it's a much safer kind of asset, in terms of, like, it doesn't have these crazy up and down swings, because it's not nearly as easy to manipulate as the crypto markets. In the crypto markets, it's the Wild West. So there are a lot more manipulators. Now, I'm not saying the S&P 500 is safe. Just that it's probably harder to manipulate than the crypto markets, where you can have a single individual running these super big scams, where if you look at it, FTX ended up losing customers like $8 billion, and then their hedge fund had taken in, I think, some like was managing some like 3.8 billion or over $3 billion, and you look at the billions and billions of losses involved. It's really mind blowing. So when I look at this whole situation, that's all I can say is like you want to watch out for these manipulations, and there are safer things to invest in, right? Like if you want to make some extra money for yourself, and that's why I recommend like doing like a side hustle. If you do like a side hustle in e-commerce, you don't even actually need to put any of your money on the line. You can start up a store on the cheap, using like a free open source platform that lets you build up an online store, and you can get into e-commerce. So those are much safer ways to like do a side hustle than going into crypto trading or investing in crypto. You can do info products. You can sell your knowledge online. Those are the kinds of side hustles that I personally recommend. And going into crypto trading, while some people have been able to make it work, I think it's very risky, very dangerous for the reasons I listed. And if you are one of those with expertise to do it, and you're doing it and it's working for you, more power to you. Like that's great. But for the ordinary individual who is not a master of these markets, um, you really need to be aware of some of these dangers involved in, so that's what I had for you guys today. And if you need some resources to help you with your products, getting your side hustle off the ground, you can grab some of my free downloads. The links will be in the description.